Hello, everybody, and welcome to The Longing Day 43. Bank. To see what kind of stuff I wanted to talk about today. I'm gonna check on the mushrooms, but the first thing that comes to mind is a thing I've been trying to think of for a while when I try and understand finances and stock markets and stuff. That's like the most boring fucking way to start an episode, but it's a question I have and it's what's on my mind, and this show isn't supposed to be interesting. Was with stock prices, what the fuck is up with how that works? Specifically, everybody acts like, oh, the way the stock market works, and this just makes sense, is that stocks are valued based on their respective companies, like how well they're doing, or like what the company is valued at. But as far as I can see, that's kind of bullshit. That's like an illusion. And one second, let me pick up these mushrooms and plant them. We grow the mushrooms. By the way, I'm pretty sure this is not how you grow mushrooms. You don't pick the fruiting body of the mushroom and then shove it back on the ground. No, fuck, don't eat the mushroom. I think that's gonna. Oh, I think. I heard that kills you. Am I gonna die? I think I might die. Well, let's hope we don't die. I'm pretty sure Ben told me that, or somebody told me that they got spoiled that the mushroom kills you. Fuck. Hope I don't die. Welp. That'd be really stupid if it was just a misclick like that. Well, but so people are like, okay, so the way the stocks work is that obviously that just the stock price goes up if the company is doing well, and it goes down if the company is doing bad. But that's not how it works, more or less at all, at least from what I can see. It's entirely based on supply and demand of whether or not people want to buy the stock. And the stock is loosely tied to the company at best, it feels like to me. I'm trying to understand that. I'm not saying I'm an authority on the matter. I think obviously there's something I'm missing. But from my layman perspective, the only way that a company is tied to its stock value is at the very beginning. Not the only way. There are some small other ways, but the biggest way is at the beginning. When a company, not all companies are public. There are companies that are private which don't have stocks or anything like that. And if people invest in it, you have to do it privately with the company. And then there's public companies. And public companies, I guess they have to go public and follow some procedures and stuff. And the way that they start with their stock and the way this whole stock gets started is through what's called an initial public offering, or an IPO. And during the IPO, I don't know exactly how they set their valuation for their stock price and how and all of that. It seems like, to me, it seems like you could do this fairly arbitrarily, but they set an amount of stock they're going to sell and they set a price for it, and then people buy it. And when they're doing that first buying it, what people are doing when you buy it during the IPO is you're giving money to the company to buy that stock. That is not the case for the rest of time, as far as I understand it, unless they do a secondary offering, which is an entirely different thing. But that initial offering, you give them the money, they give you the stock, and you're technically, you now own part of the company, but in practice it kind of doesn't work that way unless you own a giant amount of stock, in which case it sort of is true. But in reality, if you buy like one stock in a company, you, in most practical sense, you don't actually own anything in the company. All you own is that stock, which is this pretend idea, sort of this fiat currency almost, of this stock that is now entirely dictated how much it's valued by supply and demand and perception of how it's supposed to work. which I guess in some ways is similar to the way any fiat currency, like the dollar, any currency works that's not backed by anything. But here it's like theoretically kind of sort of backed by how much the company is worth, but in practice that you wouldn't get anything back if you were to like ask like, oh, I want to get something back for my stock unless somebody values it that way, theoretically. But so like for instance, if you then want to outside of initial public offering, outside of an IPO, you want to buy stock, which is what almost always happens. Like you barely ever would buy stock in like an IPO. It's always when you hear about stocks and like news and stuff, you're hearing about like people trading it like otherwise. And when you buy a stock outside of the IPO, what you're doing is you're not giving the company money. No money is exchanging hands between the company after that initial thing. Like the stock is not completely, but it's basically detached from the company. And it's just people's perception that the stock is attached to the company at that point that keeps the stock somewhat consistent with how the company is doing, but not really. Uh, so when you buy a stock, you're not buying it from the company, you're buying it from somebody else who had the stock however way that they got it, whether it be from another person again or from the IPO. So, for instance, if you buy a stock in like a company like a tobacco or a coal or an oil company, for instance, maybe you don't like those companies, you think like fuck those companies, they're fucking up the world, and you could buy their stock and you're not actually making that company any money because you're not giving your money to the company, you're giving your money to somebody else who is now selling out of their stock position. So it's this weird scenario where like everybody acts like you're helping the company, but you're not actually. It's detached from the company. There are a couple of ways in which it's sort of attached to the company, but not really. One is through this situation where I guess the idea is that CEOs and like people in charge of companies are like contractually or by law sort of obligated to try and make stock price go up. I don't completely understand that, but that seems to be the basis of my understanding is there is some paper-based like law reason that CEOs and stuff are supposed to try and make their stock price go up, which the way you do that, I guess, is by making the company look good. Because it's not like you can make the stock price go up in any like particular way that makes like logical sense in like a concrete way. You can own since the stock isn't actually tied to the company except by perception, the only way to affect the stock price is through perception. So to be able to make the stock price go up as they're supposed to do, they don't actually like it's more important to affect the perception of your company than it is to actually make your company do well. So what you get is situations where they use backwards weird shit, these CEOs, to make their company look good instead of make their company actually good because they don't care if the company is actually doing good. They care about whether or not the company looks good because is what fulfills their objective, which is to make the stock price go up. So you'll have them like, theoretically, you can sell off a big part of the company and then like track that sell off as earnings and then tell people, look how much our company earned. And then people will be like, oh, that must mean that their stock price goes up. My perception has changed and now I'm going to like buy or sell based on that, and the stock price through supply and demand may or may not rise. The hope is that it would rise through that perception. But it's this giant fucking illusion based on this weird system. It's so odd, and most people never think about it. But get into some more concrete ways of how is the stock actually tied to a company. One is that if you have enough stock in a company, if you have majority in that company, you theoretically have, depending on how the company is set up, a significant amount of power on how the company is run and what decisions are made in the company. So it's in the best interest of the company to have their stock price high so that they can't get hostile takeovers happen, which is where somebody just buys up a bunch of stock so that they have majority in a company and that they now effectively sort of have ownership of the company. So that will create all this game theory and all this weird shit happening based around that fear. It's such a complicated and backwards, weird roundabout system that causes all this weird shit. Um, Other stuff is like, so you wouldn't. Let's see. I already explained that. Is there other stuff I want to say about this? Um, uh, I think I might have basically gotten what I wanted to say. There's just a weird system that kind of just works because of perception. I know that's honestly, you could say that about a lot of economics, but I was just surprised when I was looking into this stuff about just how illusory this system of the stock market seems to work and how fragile it appears to me. But yeah, you can say that about anything. Whatever, this is probably the most boring episode yet, besides the episode where I said literally nothing, except for the fact that I may or may not have poisoned myself with that mushroom. Whatever, I'm gonna end this episode here. If you got any better explanations to help me understand this shit, I'm trying to figure it out. Talk to you guys next time. Later.